The liquidity is obviously sitting right below 4014. So 401425, all this smooth lows here, there's sell stops resting below that. So if smart money has sold short up here, collecting what? The buy stops. So they sold to those buy stops with this run here. So where are they going to try to get out at? Ideally, market efficiency paradigm is they're going to buy from sellers at a lower price. Market's here. Where are sellers at a lower price? Below these equal lows. Just because you feel confidently it's going to go to a specific level, you still have to consider the risk. And just because you might be right about where it's going, you can't chase it. You got to trade in a premium if you're going short. That means trading in a up close candle. It's one of the filters that many times is going to serve you better than you realize now. If you can sell short and up close candles and buy and down close candles, you're giving yourself an advantage that most traders don't realize when they're trying to do entries. I want to see it get into this one, admittedly. That's what I'm watching and waiting for. Okay, and now you just submit to it. If it takes you out, that's fine. If it stops you out, it's fine. And you want to submit to the idea that how much time does it take once you enter the trade? How much time does it take for you to see it move in your favor? Or if it stops you out, how fast did it take you to stop out? Now, obviously, I'm using a fair value gap entry, but I'm using the context of that breaker. So it kind of like allows for more of the things I like to look for in price action. Now, there's a small little volume imbalance in here. I want to see it trade through that and not get back above it once it does go below it. Now you reduce the risk, put it right above the breaker. That way, if I'm stopped out, it's a small little loss. I want to see it right here stay heavy and go lower. That would be an immediate rebalance. And also, you want to indicate in your journal that you're trading ahead of FOMC. So you are in a market climate that is not conducive for high precision. It's not conducive for low resistance liquidity run. It means the easy salad days type trading. That's not where we're at. But you want to practice in these conditions, because by practicing in these conditions, you're preparing yourself really when the market's more free to move. In other words, when it's easier to see it rally or drop into levels that you expected, when it's just real sudden movement, all one favor, just digging into it. My eyes watching how we traded that low. I want to see it trade to that low and expand quickly to get these sell stops. That's what I'm looking for. Now you want to remove the risk because you've gone into new sell side. If it stops you out at this point, who cares? But because we went to this low here, the market can go back and revisit premium arrays and still not go to that sell side. So what you want to do is you want to go through how much time you're looking for something that repeats over and over again. That's highly precise. But I want you to take a look at what this chart looks like right here, right now. This up close candle, this up close candle, and that up close candle. That's all my breaker. That high is 4025.75. The high of this candle comes in at 4026 even. So it went one tick, which is a mohawk. Price has to go up one tick to allow delivery of perfect old high. The difference between the bid and the ask is one tick. So it has to do what? It has to at least go up there to offer the opportunity for that high to be booked. But that framework, how do you know ICT? How do you know that when it was rallying like that, how do you know that it won't go above that high there? The difference between yesterday's closing price and regular trading session to where we opened today at 9:30, that separation, that distinction between those two price points is important. That's the opening range gap. So if we open to a premium, it opens like it does here. It rallies, comes back down, rallies once more. Perfect. We're watching now to see that fail. This is a trap. This down here allows them to do what? Chase it. Longs can say, okay, I missed the initial run up here. Bears go short here. They put their stop loss right above this high. The market drops down into that opening range gap high and then rallies. I did not take the short that I was interested in if it would have kept that candle with a fair value gap. I would have shorted that then. But because I was using the dollar index to filter, it kept me from doing what? Getting in prematurely. Plus, the structure really wasn't all that. It was just not, it was not there yet. So I mentioned that how looking at the other markets, I said, okay, it looks like NASDAQ is looking like it wants to make a higher high. Let's take a look at NASDAQ real quick. So there's those relative equal highs. I said we would like to run up above that. It did that. Look at the Dow. See that divergence there? That's why I was trusting that we were not going to go higher, and that was absolutely a good breaker on ES. So let's go back to ES. This down close candle, these series of 3 down close candles, is the context behind that run up here that stops out anyone that was going short here, because they want to do what? They want to fade the gap, right? Okay. The algorithm knows that. It's going to come down, rally through it. All the buy stops are gone. Why is that useful? Just like I mentioned to you, smart money will sell short to those buy stops. They're going to sell to those buyers at a higher price. Smart money's accumulating this area here, up in that area. That's where smart money's going short, with the expectation that they want to do what? Buy it back at a cheaper price. But who would be willing to sell it to them at a cheaper price? Anyone that's long here or went long on here, it's the idea that this is support, where they're going to place their stop loss, where they just got wrecked. So when smart money's entering a short, the market efficiency paradigm that I'm teaching you, the way they engage price, they're not looking at patterns. They're looking at who they can take to the slaughterhouse. They killed the people that were short. When it ran above it, they're done. They're stopped out with a loss. Anyone that was short here gets stopped out. Anyone that went long down here, oh, it's gap and go day. No, it's not. Listen to what ICT said. We're going to rally up, take a new high, and then we're going to watch and see, does it peter out? And it did. The market goes back down and takes out the longs. So who's really right? The smart money selling here, and they're going to be buying down here. So when I'm looking at price, I'm looking at this to that. Shorting, buying it back. The context is selling at a premium. If you can't get that price and you're submitting yourself to what? Like I taught in the 2022 model, wait for the displacement. This is the shift in market structure, right below that low. Then we have two fair value gaps. You can sell short in here, but you got to incorporate this fair value gap too. Why? Because it's inside the breaker, which is what I outlined here. And the market does what? It rallies up. I am not concerned about it making a higher high because we already have at that high versus this high, the Dow has made a lower high. That's SMT. That's tipping its hand. The algorithm is showing its crack in correlation. It's telling you that this rally is a suspect rally, meaning it's only going up to take the stops out for anyone that's short. But I'm not concerned about it going above that high because I know that the algorithm is going to refer back to that candle's high because the context that books price in this algorithm repeats. It's going where orders would be resting. It's going where inefficiencies are. That's the only thing it does, folks. That's it. Or it does this, sideways. It's going up for buy side, or it's going up to go into a premium fair value gap, some kind of inefficiency, or it's dropping to old lows where there's sell side, or it's dropping down to some discount inefficiency. Now, look at it through the lens of the 2022 model for a second. We see a high, the market rallies up. Did I use any other time frame? No. I traded right off of this time frame here, using the tools that I've already taught you in 2022. Trades below it, does it have a fair value gap? Remember the range I told you from here to here? In that range, all of this is protraction. So in that range, when it starts to drop back down, we're going to be anticipating what forming? A fair value gap. There was two of them, here and here. The rules I gave you in the 2022 model last year was if you have two fair value gaps, you have to at least allow for price to trade up into that second one, because it can. But more specifically, because we have that breaker there. Because the breaker is a factor here, we have to at least make an allowance for it trading up to the high of that. So I'm not concerned if it goes to that candle's high in one tick or two. Because if it did that, that's fine. That means I'm going to go bullish now. Because it would erase and cancel the SMT divergence between the Dow and its lower high when the NASDAQ and ES, like we show here, made higher highs. So it would be a stop out on one trade, but it would give me insight into being a net long trader the rest of the day. Because it should not have failed. This is where the price was going to gravitate to. It was going to make a higher high. The model for 2022, if you take the low, well, let's just do it. There's the low up to the high right there. Here's the 50% level. That's equilibrium. So we have to find something as a discount below that level. Well, we have these lows, this low, and then these relative equal lows here. Which one's more likely to have the bigger pool of liquidity below it? Obviously this one here. And it's nicely below the 50% level. So we're in a discount, and we smashed all the way down into it.